Welcome to Casense.
Imagine a plan to build a massive battery plant in India. It requires a 1,500 crore rupee investment right now before a single brick is laid. The catch is that the entire business depends on government incentives. If those policies change next year, the demand for your batteries could vanish, leaving you with an expensive, empty building. Standard financial models try to predict this future today. They weigh the potential for success against the risk of policy changes and come up with a single number. For this plant, that number is 40 crore rupees, a tiny margin for such a massive risk. When a project looks this borderline, most companies simply walk away. They treat the investment as an all-or-nothing bet that has to be won or lost on day one. The problem with those standard models is that they assume you are locked into a single path. They calculate the value as if you have no power to react once the world starts changing. Real option valuation is a different way of thinking. It treats your big decisions like options, the right, but not the obligation, to take action only when you see the conditions are right. Instead of betting everything on a fixed 5-year plan, you break the investment into smaller pieces. You move forward only when the uncertainty clears. This means you are no longer committing to a single final outcome today. You are paying for the ability to see how the market reacts before deciding whether to spend the rest of your money. To see how this works, look at how Voltgrid reframed their choice. Instead of the full plant, they decided to build a smaller Phase 1 for 600 crore. This smaller step gave them the right to expand later for an additional 900 crore. They locked in the cost and the plans, but they gave themselves a 3-year window to decide if they actually wanted to pull the trigger. This is the stage option, but there are others. You can buy the right to delay a project, to shrink it if sales are slow, or even to switch your equipment to make a different product entirely. Before you can put a price tag on flexibility, you have to define these points of choice. You have to name exactly where you have the power to change your mind. Once the choice is framed, we look at 4 variables to see what that flexibility is worth. Think of it like a scale. On one side is the value of the finished factory if it were running today. On the other side is the price of the check you'll have to write later to actually build that expansion. Then there is the window of time. If you only have 2 months to decide, that's not much of a window. But a 3-year window gives you much more time to watch the market and wait for the perfect moment. Finally, we look at how much the market swings. If battery prices and government incentives are stable, the future is easy to predict. But if they are swinging wildly, the value of waiting increases. This is counterintuitive. In a normal plan, wild swings are a threat. But when you have the option to wait, those swings are an opportunity. You only act if the swing goes in your favor. This is where the math changes. Because you only expand if the market is strong, you have effectively removed the possibility of spending 900 crore on a factory that no one needs. You keep the upside, but you cap your potential losses. When you remove those massive potential losses from the calculation, the value of the project changes. For Voltgrid, the value jumps from 40 crore to 350 crore. You are no longer paying for the risk of being wrong. To make this work, you need triggers. These are hard rules that tell you exactly when to move from Phase 1 to the full expansion. Voltgrid set a clear rule. They would only expand if they secured 260 megawatts of orders within a year. If they didn't hit that number, they would stay small and avoid the extra cost. By setting these mathematical gates, you take the guesswork out of the decision. You aren't expanding because you feel lucky. You're expanding because the data hit the target you set in advance. 18 months later, the initial market uncertainty cleared completely. Government policy stabilized, and Voltgrid's orders surged past their 260 megawatt trigger. With those orders already in hand, the company could commit the remaining 900 crore to the expansion, knowing the demand was already there to meet it. By waiting for hard evidence before committing their largest chunk of capital, they protected their cash while positioning themselves to catch the wave when it finally arrived. This framework is specifically for large, expensive projects that are hard to undo, like energy plants, new tech platforms, or company mergers. It isn't helpful for simple, low-risk decisions, or for situations where you don't actually control the timing of the choice. You also have to watch the competition. If you wait too long for perfect information, a rival might build their factory first, making your option worthless. The real world will never fit into a perfect spreadsheet. Success comes from accepting that the future is unpredictable and then building the flexibility to act only when the odds are in your favor.